Lauren Kennedy here today with Evan New, and we're doing a weekly recap for Tech Teardown for the week of Friday, November 8th. The public debut of Twitter was easily the biggest tech story this week. After a phenomenal first day with the stock jumping nearly 75%, Twitter's swinging all over the place today as investors try to assess the company's prospects. Let's dig in a little deeper here. Twitter has a lot of work to do on the international front. Is this common for social media companies?
It really is, Aaron. If you look at the composition of users versus revenue in geographical terms, Twitter has 23% of its users in the U.S., 75% of revenue comes from the U.S., LinkedIn has 34% members in the U.S., 62% of revenue in the U.S. Facebook 17% users in the U.S., 48% of revenue in North America. I mean, it's really just a common pattern that a smaller portion of users is driving the majority of their revenue.
Why is that? How can you explain that their international is so much smaller?
I think that these companies naturally just have more familiarity with how markets work and how their businesses are going to operate in their home countries. And as they try to expand into other countries, they have to kind of learn because there's always like these local nuances when you're trying to expand into new markets. There might be things like regulation, culture, and different user engagement patterns. A lot of things to consider.
So do you see an opportunity for Twitter here?
I do, because on one hand, they certainly they want to grow their user base everywhere they can, but just in terms of monetization, if they can just improve monetization internationally, then they can continue to grow the revenue. They're investing heavily in sales, growing their sales force in places like Australia, Brazil, Canada, Japan, UK. In their prospectus, they do expect greater user growth from some of these areas, and they're also trying to integrate sales in-house, because right now they rely on resellers in some of these regions.
Do you see any challenges that Twitter might be facing internationally?
There are a lot of copycats, because Twitter's been around for a while. And while before they've kind of expanded into other markets, local players have kind of come up to meet that need. Line in Japan, Kakao in South Korea, Sina Weibo is also the predominant microblogging service in China. They're up to about 54 million daily active users, and Twitter is blocked in China. So Sina has really stepped up to meet that need in China, and kind of like how Facebook can't get in China, neither can Twitter.
Let's talk about Twitter's ability to become profitable. Facebook was solidly profitable when it went public. Twitter's not.
That's right. So Twitter so far, year to date, they've lost about 133 million net loss. Now, at the same time, if you look at their cost structure, their gross profits are actually scaling quite nicely. Their primary cost revenue is data centers, building, maintaining, operating, which is largely a fixed cost. And when your cost structure is predominantly fixed cost, you actually have some operating leverage as your revenue ramps up. So their gross margin has actually increased from 42% in 2011 to 64% year to date this year. So that side of it is going nicely. So I think there's some light there at the end of the tunnel. That
said, though, what do you think's really holding Twitter back here?
So the trouble that they're having right now in terms of getting to profitability is really on the operating expense side. Specifically, R&D and sales and marketing are two areas where they're really investing heavily. As you just talked about, they're trying to expand internationally. Really need to beef up their sales team, R&D on how to get into those markets. But the good news is that eventually, as the business matures, they should be able to rein in these operating expenses, and then at that point, you let the operating leverage do its thing. And I think there is a very good chance that Twitter will become profitable in the near future.
So, drop all the hype. Do you think Twitter is a buy?
I don't think it's a buy at these prices, because they've jumped so much, and I think right now there's so much hype around them. Just looking at the valuation figures are astronomical. They're trading at nearly 50 times sales. I was very interested at some of the initial pricing ranges, but now we're basically twice those ranges. And I think it's just come up too much. And I like the business. I like the actual business, fundamentally, but I don't like the stock where it's trading at right now.
All right. Let's talk a little bit about the IPO itself. Twitter's a household name, so there's certainly a lot of interest among everyday investors. I actually know someone who put in, the night before, went into their online brokerage, put in a limit order for 6 shares at $26. Order wasn't filled, didn't get the shares. What happened?
So when you look at the offering price versus where they opened at $45, there's a big difference there, right? About $20 in this case. So the way the IPOs, generally speaking, the way they work is that that's the primary market, and the offer price is $26. Whenever you buy at that price, that money is going directly to the company through their offering, and that's where they're raising money, kicking some back to the investment banks. But then after that happens, then shares will begin trading on the secondary market, and that's what happens the day after it prices. In this case, it can open at wherever the market wants it to open based on investor demand. In this case, the market said, hey, we're willing to pay $45 for this, even though last night it was only 26. And that's largely, like all market movements, a function of supply and demand.
So Twitter doesn't really benefit from that huge price jump. Twitter's not seeing that money. Correct.
Not directly. I mean, certainly their large stakeholders are quite happy about it, the insiders. And there's also just some perception, they like, people judge IPOs if they go up early as like a successful IPO.
Or successful for Goldman.
Right, yeah. Or for the underwriters. And then there's, certainly if an IPO drops immediately, then there's some negativity around that. Maybe it was priced too high. Obviously, Facebook ties into this conversation because of how it performed last year.
So I have a question. Theoretically, if you wanted, let's say my friend really did want to get in on this IPO on yesterday, the first day, how would you go about doing that?
So you'd have to call your brokerage, and there's a very long process to participate on the IPO. It's a very speculative investment, and brokers are very careful to screen to make sure that you're acknowledging that it's speculative. There's a lot of back and forth. You'll submit a conditional offer saying, I'm willing to buy up to this many shares before the pricing is set.
Is there a minimum of shares that you have to buy? Or?
Generally, these have to be in round lots. So we're talking 100 shares or more in increments of 100 shares. So then at that point, you say, I'm willing to buy maybe up to this amount. The pricing ranges.
That can be a pretty big investment, though.
It can be. But then after it prices, then you have to confirm with the broker and say, hey, okay, now that I know the price, I'm only willing to buy maybe what I said initially, maybe bring it down. And then the broker, if they're getting shares allocated to them, they go overnight and they allocate among all their clients. Sometimes they'll have enough to go around. Sometimes they won't. Sometimes you'll get what you want. Sometimes, there's a lot of times it's just not enough to go around.
What do you think of that strategy? Do you think it's advisable for everyday investors to jump into an IPO?
IPOs are inherently extremely volatile and extremely speculative, and there are certainly a lot of investors that like that. A lot of brokerages also have rules against IPO flipping, which is, certainly if you get bought at 26 for Twitter and then immediately sold the open for 45, almost doubled your money.
Right, you made a handy profit.
In less than 12 hours. It'd be pretty nice, but that's looked down upon within brokerages, and they might actually ding you and bar you from participating in IPOs in the future because if you're buying in the primary market, they want you to hold on for a certain period of time, and there's always a lot of volatility in there. But a lot of people like trading IPOs just because they're fun to trade and they like to bet one way or another.
All right. Let's move on to NVIDIA. NVIDIA reported earnings last night. Shares are up, so investors are obviously pleased with the results. How did the company do?
So starting with the basics, the revenue came in at $1.05 billion, adjusted earnings per share of 26 cents. NVIDIA is also boosting its dividend by 13% to 8.5 cents quarterly. Also increased another $1 billion in repurchases. So GPU, their core graphics segment, continues to really hold up well. Revenue is down 2% year over year to $877 million. But that's pretty good considering the PC environment is struggling. IDC estimates showed that unit volumes globally were down about 8% last quarter, so holding up pretty well. You
mentioned though, you just said the PC. We know the PC market has been struggling for a while. NVIDIA has been trying to diversify away from that market. Do you see any progress in this area?
We do. There was a pretty nice bump here on Tegra revenue because the Tegra business is really their biggest play at diversifying away from PCs and getting into new markets, smartphones and tablets, eventually cars and powering all these other devices. Tegra revenue has been kind of struggling this year as NVIDIA had pushed out Tegra 4 timing. And this quarter really came back in a big way, more than doubled sequentially to about 110 million. So we're seeing a really nice bounce there. That was expected, but this was pretty solid little comeback there.
So we've talked before about Tegra 4i and NVIDIA trying to get certified on AT&T. Are there any updates on this front? So
they have gone ahead and gotten certified for their 4i, their chip coming out that has integrated LTE, which is a huge milestone for them. They got that certified on AT&T, but at the same time, they're not targeting the U.S. initially with this new chip. They're actually going to be going globally with it, and because to compete in the U.S., you need CDMA, and they're not there yet. So they're really going to be targeting international markets with this new chip. The time frame is still, they're confirming that, which is also a good thing. Tegra 4i devices are expected to be announced in the first quarter, and at latest shipping in the second quarter.
This is a really crowded market, the mobile chip space. Is NVIDIA your favorite stock here, or would you?
NVIDIA is definitely the David here, and Qualcomm is the Goliath. So Qualcomm has really held down the smartphone processor market and baseband market in a big way because of its advantages in cellular integration, LTE. So NVIDIA will actually be the first company that can stand up and challenge Qualcomm with an integrated solution, which no company has done so far. So this is just beginning. So it's certainly too early to call if they're going to be successful or not. But they're giving it a good, they're going to give it a go and make Qualcomm, see if they can challenge them.
All right. That's all for today on Tech Teardown. Do you want to learn more about the tech stocks we're investing in? Just send an email to cto@fool.com and you'll receive our special free report on our Chief Technology Officer's favorite social stock. For Evan New, I'm Erin Kennedy, and we'll see you next time.